video, we'll be doing some market analysis. We're going to be looking at how markets are efficient. They're going to maximize economic surplus. We'll be seeing how shifts in the supply and demand curves affect market equilibrium prices and quantities. And we'll be talking about price controls, when governments sometimes step in because they think equilibrium prices may be unfair. Markets are considered efficient, or the equilibrium is considered the most efficient, when it's maximizing the economic surplus. Economic surplus refers to the difference between the price that is paid, the equilibrium price, and the reservation prices of buyers and sellers. On the seller side, the price paid is what they earn from the customer, from selling the item. Their reservation price is that minimum price that they're willing to accept. And so the economic surplus, or the producer surplus for sellers, is going to be their profit, that extra that they're earning on top of what it costs to produce. On the buyer side, it might seem a little bit more indirect. They pay a price, they don't get any direct profit. However, they do get extra value. So for the buyer side, they take the reservation price minus what they're paying, and they get an economic surplus as well. Some extra value that they didn't have to pay for. So the market equilibrium represents the highest level of overall economic surplus. And so we would say that markets create efficient systems. It's an efficient use of resources because we're maximizing those extra benefits and the extra money to both our buyers and sellers. This is only true, though, if all costs and benefits are actually accounted for in our markets. One problem we often have is that people are affected who aren't actually considered buyers or sellers in the market. A negative effect, for example, might be pollution. There's a factory that's polluting, and if all people in the world are not customers of that factory, but all people in the world are negatively affected by that pollution, then the market equilibrium might not be efficient anymore. And so sometimes governments will step in. They will do things to try to add taxes or change the level of output so that the costs and benefits are going to be internalized into our market model. So when we're talking about efficiency, we're going to say that we're maximizing economic surplus. The market equilibrium is the most efficient point because it's giving us the highest possible level of economic surplus, consumer and producer surplus. The problem with efficiency, which we will talk about several times throughout this semester, is that it doesn't always care about equity. It doesn't always care about distribution. So you can have a situation where you're producing the most profit for your economy, for your society, but if all of that profit is going to one person or one company, then people aren't going to be happy. It might be the most efficient use of resources in terms of we're getting the most output, we're getting the most profit, but it maybe isn't fair. And it won't always include all of the things that we value as society. It is not considered an economic loss if you don't purchase a good or service. So if my husband does not want to go to Disneyland because he says it's not worth $200 to go to Disneyland, it's not considered a loss that he's not participating in that market. Now, some of us as a society might say it's unfair. We want to make sure that people have access to stuff, that they can buy food, they can buy housing, they can have entertainment, they can do things that they enjoy. Maybe we won't say that Disneyland should be a right, that everyone should be able to go, that it should be affordable, but certainly some things we would say are basic human needs. As economists, though, we don't distinguish between needs and wants. And so there are some people who participate in the market and some people who don't. And we don't consider it a loss that my husband can't go to Disneyland, because we would say he's going to use his $200 to go do other things that are going to give him a higher level of benefit, higher level of value. And so it's still going to be efficient because he is using that money for something that makes him happier. Markets are only efficient when we have voluntary exchange. The assumption is that people choose to buy things that they want to buy, and they don't buy things that they don't want to buy. They choose to sell things because they want to own a business or they want to sell things. And it's not compulsory. What this means, though, is that if a company is not making enough money from a particular activity, they can exit the market. So if a bank is not making enough money on loans, they don't have enough accounts, they can't operate, the bank can go out of business. They're not forced to continue operating at a loss. It's the same thing with purchasing. You're not required to purchase things that you don't want. Possibly you had to buy some textbooks for your classes and you would have preferred to buy something else. But sometimes you don't buy required textbooks, right? So it's not compulsory. It's required, it's recommended, but there still are options. There still are choices. And the idea is that the economy has this invisible hand, this thing that's kind of moving us to that equilibrium point where buyers and sellers are agreeing on a price and quantity. Households and firms are all working in their own self-interest, and that simultaneously promotes the interests of society. Let me show you how to view economic surplus on a graph, as well as how to calculate the value. Economic surplus is going to be a dollar value. So from the seller side, it might be the value of their profit, the extra money that they're earning. On the buyer side, it's the total extra dollar value that buyers received that they didn't have to pay for. Since we are using constant curves here, we get to do a little bit more simple calculations, and all of our surpluses are going to be triangles. If you remember from way back when in math, the area of a triangle is going to equal 1/2 of the base times the height. So if we draw this triangle here, this red triangle going from 0 to 10 on the price scale, and then from 10 to 60 on the quantity. The base is going to be the horizontal distance between the y-axis and whatever your point of your triangle is. In this case, the base of our triangle is going to be 60. The height of your triangle is going to be the vertical distance parallel to the y-axis or the price axis. So in this case, the height of our triangle, this whole full height, is 10. So if we're trying to calculate the area of this, we would say 1/2 times 60 times 10. And that's going to give us a value of 300. Now 10, the height of our triangle 10 is in dollars. And so we would say the value of this is $300. So in this market, there's $300 of surplus available. On the consumer side, it's the extra value that consumers got that they didn't have to pay for. So for consumer surplus, if we wanted to only view that portion, we would take the price paid, which is going to be this dotted line here at the equilibrium price. And then we're going to go up along the y-axis until we hit the intercept of the demand curve. And then we're going to go down the demand curve until we get to the equilibrium point. So this upper triangle here, this represents consumer surplus. This is all of the extra value that the buyers in our market receive that they didn't have to pay for. And that happens because we have one price, but we have different reservation prices. So our equilibrium price is $4 here, but the customers in our market value it at $4.25 and $6, $9, all the way up to $10. And so we have values that are higher than what people are having to pay. So we can calculate the area of this triangle as well. We would do the same thing, 1/2 times the base times the height. In this case, the base is this horizontal distance here between the y-axis and the point of our triangle. It's going to be 60. The height of our triangle is going from 4, because that is the bottom here, where the price our customers are paying, all the way up to 10. So the height of our triangle is actually 6. So in this case, we're going to get 1/2 times 60 times 6. That is going to give us a consumer surplus of $180. We could do the same thing for producer surplus. It's going to be the extra money received by the producers above their marginal cost of production. So it's going to be the area between the price and the supply curve. So we're going to start at the price. This is going to be the top of our triangle. For the base, it's still going to be 60. Whenever we're at market equilibrium, the base will be the same for both producer and consumer surplus. And in this case, the height is going to be 4 all the way down to the origin, which is going to be 0. Okay, so our height is going to be 4. Now, I noticed in this graph, it looks like our price axis is actually a little bit skewed. So it is not quite to scale. I do apologize for that. So in this case, our producer surplus, 1/2 times 60 times 4 is going to be 120. Together, this equals $300 in consumer and producer surplus. So our total economic surplus is going to be $300, 180 going to our consumers and 120 going to our producers. So this bottom triangle here is our producer surplus. It can be equally split, so they can each get half. A larger portion can go to the consumer, a larger portion can go to the producer. It just depends on how the slope of the supply and demand curves, where that equilibrium point is, and where the prices are as well. Let's look at a couple of examples. So for market analysis, we want to know what's happening in our markets. Why are some things getting cheaper? Why are other things getting more expensive? When we look at the world of personal computers, we can see that the computing power has increased significantly over the past few decades. Computers and phones are getting more and more powerful. They're also often getting cheaper as well. Both the demand and the supply are increasing for personal computers. Demand is going to shift to the right, so we have an increase in demand. More people want computers. We're using them for work, we're using them for personal activities. Oftentimes there are multiple computers in a home, one per person. Used to be when computers were new, there would be one in the household that everyone would have to share. Sometimes this is happening because of higher incomes. People are making more money, so demand is increasing for computers. Or tastes and preferences are changing. People just like computers more. There's more stuff that we need to do now with computers than when they first came out. There's so many new uses. We use it for work, we use it for photos, for email, lots of different activities that just didn't exist before. So the demand for computers is increasing. The supply is also shifting to the right. So we're seeing an increase in the supply of computers as well. Partly this is due to technology improvements. Companies have figured out how to produce it better, how to produce it faster, how to produce it smaller. There's also a lot more manufacturers. Many more companies have seen that there's profit available in this market, and so they've entered the market as new suppliers, shifting that supply curve to the right. So what we see is that the cost is actually dropping by about 50% every 12 to 24 months. And this is in terms of per unit of computing power. So there's different ways that you can actually measure this. You might look at a laptop and say, oh, laptops are getting more expensive. But when you look at how much they can store, how powerful they are, how quick they are, their battery, the quality of components, it's getting better faster. So even if you look at the average price of a computer and seeing that it's going up, when you look at the price of the computer per unit of whatever features it has, it's actually dropping. Another example we'll look at is the crude oil and gasoline market. Crude oil is a component in the production of gasoline. It's the natural resource that's turned into gasoline through a refining process. The price per barrel of oil is determined by the supply and demand of crude oil. We could see in this top graph, demand for oil increasing is going to cause the price of crude oil to increase. We may also see a decrease in the supply of oil. That's happened several times throughout history, and oftentimes when there's large amounts of inflation in the U.S. economy, it's linked to a decrease in the supply of oil and an increase in the price. About half of the price of a gallon of gasoline is determined by the crude oil price. So if the price per barrel doubles, you may see the gasoline cost doubling, but oftentimes it might only need to go up by a quarter, 25%. It's also determined by the other costs of production. There are labor costs. There's the refinery process. So there's machinery, technology, other things used that cost money to turn crude oil into gasoline. It costs money to distribute gasoline to gas stations around the country. There's also taxes and corporate profits that play into the gas price. Gas is an input to nearly all other goods, in the United States at least, and in many other goods and industries around the world. Higher oil prices actually cause the supply of other goods to shift to the left, since gas is an input. So when we have an increase in the demand for crude oil, it's going to raise the equilibrium price of crude oil. This is going to raise the price of gasoline, which is increasing the input costs of production, which will shift our supply curve for other goods to the left. You can see that down here on this bottom right graph, leading to higher prices and a lower quantity for all other goods produced. Now, gas prices tend to be very volatile. They change up and down every day. They can increase for months at a time and then suddenly drop, have a sharp increase and then a slow drop. Oftentimes, companies don't want to constantly change the prices of their products, so they may try to predict what's going to happen over the next year or 2 years with gas prices and build that into their current pricing model. But it does affect profits, it does affect production costs, and over time, as gas prices rise, it does increase the overall costs of products for consumers. Why are gas prices changing so often? Why is it so volatile? Some of it has to do with seasonal demand. There are certain times of year where gas usage goes up. Consumer gas for their cars. During certain times when we do a lot of online shopping, maybe the demand for gas goes up for delivery trucks. In certain places like California, there's seasonal additives. So during the summer months, California requires a different gasoline blend than in the winter months. This is one way that they're trying to combat pollution in California. And so gas prices in California increase during the summer months. There's also output fluctuations. So the supply of crude oil changes over time. Oil is an interesting market because people often buy what's called futures contracts for oil. They're not necessarily purchasing oil that they want to have right now. It is used as a financing tool. It's used as an investment tool, and so people buy and sell oil and they trade it on the commodities market. Output fluctuations can happen because there's a very small number of producers. It is a limited resource. It's a very limited resource. Sometimes there are political issues that cause some of the large suppliers to change how much they're producing. There could be natural disasters. There can be issues with refineries. There can be issues with the production process that makes gas not as available or an abundance of gas available. And so the supply of gasoline, the supply of crude oil are going to have a big effect on gas prices overall. This graph is looking at how oil prices, the world oil prices, affect U.S. gas prices. So we see this orange line here is showing us the crude oil price per gallon, and the green line is showing us the average price per gallon of regular gas. So the green line is higher than the orange one, which makes sense because crude oil is just an input. There's other costs in production. But notice how these lines follow each other fairly closely, going up and down at very similar patterns throughout this 2-decade period on the graph. So even though there are other costs, refinery costs, corporate profits, other things, the main thing contributing to the cost of oil or the cost of gas is that cost of crude oil. So changes in the supply and demand of crude oil affect that equilibrium price and then have a very direct effect on gasoline prices. So which countries are the top consumers of oil? Which countries use the most oil around the world? This is as of May 2022. The United States is the largest consumer of oil at 20 million barrels per day. about 20% of the world's oil. China comes in next at 14%, India at 5%, Japan and Russia at 4% each, Saudi Arabia, Brazil, Canada, South Korea at 3%, and Germany at 2%. So the top 10 oil consumers use about 61% of the entire world's supply of oil. Which countries are the top producers of oil? I'm sure you may have heard some things about this country has a lot of oil, this country makes lots of money off of oil. So what do you think? Who are the top producers? The United States is actually one of the top producers, currently producing about 20% of the world's supply of oil, about 19 million barrels a day. Saudi Arabia is next with about 11% of the world's oil. Russia also produces about 11% of the world's oil. Canada is one of the top producers at 6%, so they supply about twice as much as they use. China at 5%, Iraq, United Arab Emirates, Brazil, and Iran at 4%, and Kuwait supplies 3%. So the top 10 oil producers supply about 72% of the world's share of oil. When I first saw this information, I was a little bit surprised. I would not have expected the United States to be a top producer of oil, because when I hear stories in the news and stories about politics, it's always about how we need foreign oil and we're dependent upon the oil of other countries. But it seems like we're producing almost as much oil as we're consuming. So what's going on here? Why are we using foreign oil if we're producing nearly as much as we're using? Part of it has to do with the capabilities, the technology capabilities, the production process, the quality of the oil, the refinery process. The U.S. has really high quality refineries. We can actually turn the worst crude oil into gasoline. Other refineries around the world need higher quality oil, which the U.S. actually supplies. So we take our more expensive oil, we sell it to other countries, and then we buy their cheaper oil. So it's a way of making money, increasing the profit available in the United States. So we sell our good oil, we buy the bad oil, we refine it, and we still get the gasoline that we need. Sometimes governments do not like what's happening in markets. They don't care that equilibriums are efficient, and they may say that a market equilibrium is unfair. Prices are too high or prices are too low. Somebody's being harmed in this. And so governments will often step in and they will institute price controls. A price control is any time the price is set above or below what the market equilibrium price would be. Generally, this happens when prices are considered unfair, but this is a normative statement. So the determiner of what's fair and what's unfair is really a personal opinion, personal value statement. When governments are deciding this, they may talk to constituents. It may depend on their political party, other things happening in the political process, but somebody has deemed this unfair. A price ceiling is when the government institutes a maximum price. The graph here on this slide is showing a price ceiling. Our equilibrium price in this market is at $60. The government may decide that this is too high, this is unfair, and so they set a price ceiling at $40. So a price ceiling is going to be below the market equilibrium, and it's preventing prices from going any higher because we have a natural tendency to want to move to that equilibrium point. At $40, we have a quantity supplied of 4,000, and we have a quantity demanded of almost 9,000. So in this market, when we add this price control, a legal maximum price, this is going to cause a shortage in our market. Normally, if there was no price control, a shortage would be a signal that businesses could raise prices, increase production, and get back to that equilibrium point. Price ceiling is below the equilibrium. A good example of a price ceiling would be rent control. Certain cities, certain areas have very high rent, very high demand, very limited supply, and sometimes governments will set rent control. So in New York, there are certain apartments that there are legal maximum limits on what the rent can be for those. A price floor is the opposite. It's going to be a minimum price. Interestingly enough, the price floor is going to be up here. So a price floor would be above the equilibrium. And this is a legal minimum price because it's trying to prevent prices from going down to that equilibrium point. So think of the equilibrium as the middle. So we're having a price control sandwich. Equilibrium's in the middle, the floor is above, the ceiling is below. So our room is upside down, right? The floor is above the ceiling. So price floor is any time a minimum price is set above the equilibrium. Good example of this would be minimum wage. So if you have a city where the minimum wage is $15 an hour, the idea is that the market wage would be lower, maybe $13 an hour. So the government says this is too low. We're going to institute a minimum wage that you have to pay above the market equilibrium. Then you get a quantity demanded that's less than your quantity supply, and this causes a surplus. In a wage situation, this would be a labor market. So a surplus in the labor market means we have a lot of unemployment because the quantity supplied is the number of workers and the quantity demanded is the number of jobs available. Oftentimes, price floors are also set in agricultural markets as well, which we'll talk about more later. So price ceilings cause shortages. Price floors cause surpluses. The market is no longer in equilibrium. We're in disequilibrium. Quantity supplied and quantity demanded do not agree when there's a price floor. This still may be a good thing. You may want to have minimum wages or rent control, agricultural subsidies, but then we just say, well, now we're not being efficient. Maybe we've created another problem. We've created more unemployment, so now we have some extra problem to fix. That's going to be the end of this video in market analysis. I will see you next time.